If you are over 60 and you own your home in Australia, there is something you need to hear right now, because most homeowners in your exact situation are sitting on thousands of dollars they do not even know they are entitled to. And worse, many of them are making small mistakes today that could cost their family a huge amount of money down the track. Stay with me for the next few minutes, because I am going to walk you through 5 things every homeowner over 60 in Australia should be doing right now. And number 4 is the one almost nobody thinks about until it is too late. Welcome back to Australia Pension and Centrelink Update, the channel where we break down everything happening with the age pension, Centrelink, superannuation and retirement planning. In plain simple language, no jargon, no confusion, just what you need to know to protect your money and your future. If this is your first time here, hit that subscribe button and tap the bell, because we post regular updates on pension rates, Centrelink rules and practical tips just like this one. Now let us get straight into it. The first thing you need to do is check exactly how your home affects your age pension eligibility. A lot of people assume that because they own their home, it automatically counts against them for the assets test. The truth is more nuanced than that. Your principal home is actually exempt from the assets test, which means Centrelink does not count the value of the home you live in when working out how much pension you receive. However, and this is the part people get wrong, if you are a homeowner, you have a lower assets test threshold than someone who does not own a home, because Centrelink assumes homeowners have less need for additional assistance. This means the rest of your assets, your savings, your car, your superannuation and any investment properties are assessed against a tighter limit. So the first thing to do is sit down and get an honest picture of everything you own outside the family home and compare that against the current assets test thresholds published by Services Australia. Thresholds change periodically, so do not rely on a number you heard 2 or 3 years ago. A quick call to Centrelink or a chat with a Financial Information Service Officer, which is a free service available through Centrelink, can give you the most current figures for your situation. The second thing every homeowner over 60 should do is look into the Home Equity Access Scheme. This used to be called the Pension Loans Scheme, and it lets eligible older Australians, including some who are not even receiving a pension, borrow money against the equity in their home to boost their retirement income. It works a bit like a reverse mortgage, but it is run by the government through Services Australia, and the interest rate is often more competitive than what you would get from a private reverse mortgage provider. The way it works is you receive a fortnightly payment on top of any pension you already get, or as a standalone payment if you are not eligible for the pension, and the amount you borrow accumulates as a debt against your home, which is only repaid when the home is eventually sold, usually after you pass away or move into aged care. This is not the right option for everyone, and it does reduce the equity your family will eventually inherit. But for homeowners who are asset rich and income poor, meaning you own a valuable home but do not have much cash coming in each fortnight, this scheme can be a genuine lifeline. The key thing is to actually sit down and run the numbers, because so many eligible Australians have simply never heard of this option, and they are missing out on extra income they are entitled to. The third thing to do, and this one is often overlooked, is to review whether downsizing makes financial sense for you, and to understand the Downsizer superannuation contribution rules if you do decide to sell. If you are over 55 and you sell your home that you have owned for at least 10 years, you may be able to contribute up to a substantial amount from the sale proceeds directly into your superannuation outside of the normal contribution caps. This can be a powerful strategy because superannuation in the retirement phase can generate tax-free income, and it can also affect how Centrelink assesses your assets, since money sitting in super in the accumulation phase before you reach pension age is treated differently to money you hold personally. Even if you have no intention of selling right now, it is worth understanding these rules because circumstances change, whether that is health, family situations, or simply wanting a home that is easier to maintain as you get older. Knowing your options in advance means you can make a calm, informed decision rather than a rushed one during a stressful time. The fourth thing, and honestly this is the one that catches so many families off guard, is getting your estate planning and enduring power of attorney documents sorted and making sure Centrelink has your correct nominee arrangements on file. Here is why this matters so much. If something happens to you, whether it is a sudden health event, a stroke, an accident, or the gradual onset of dementia, and you do not have a valid enduring power of attorney in place, your family cannot simply step in and manage your Centrelink payments, your bank accounts, or decisions about your home. They may be forced to apply to a state tribunal for guardianship or administration orders, which is a slow, stressful, and often expensive process, all while your bills still need to be paid and decisions still need to be made. Setting up a power of attorney costs very little in comparison, and it can be done at any solicitor or through community legal services, some of which offer this at low or no cost for pensioners. On top of that, make sure you have registered a correspondence nominee or a payment nominee with Centrelink if you want a trusted family member to be able to communicate with them or manage payments on your behalf if you become unable to. So many families come to realise the importance of this only after a crisis has already happened, and by then it is much harder to fix. Do not wait for an emergency to sort this out. It takes an afternoon now, and it can save your family months of stress later. The fifth thing to do is stay on top of any changes to your circumstances and report them to Centrelink as soon as they happen. This might sound obvious, but it is one of the most common reasons people end up with an overpayment debt they did not see coming. If your income changes, if you receive an inheritance, if you sell an asset, if your relationship status changes, or if you start receiving money from a family member, all of these things can affect your pension payment, and Centrelink expects you to report changes within 14 days. The good news is that reporting is much easier than it used to be through the Centrelink app or your online MyGov account, and it only takes a few minutes. The reason this matters so much is that if you do not report a change and Centrelink finds out later, which they usually do because of data matching with the Australian Taxation Office and other government agencies, you can end up with a debt that has to be repaid, sometimes with additional penalties. Staying proactive protects you from that stress entirely, and it also means your payments are always accurate, so you are not accidentally missing out on entitlements either, because sometimes a change in circumstances actually means you are entitled to more, not less. Now, if you take just one thing away from this video, let it be this. The age pension and Centrelink system in Australia is not designed to work against you, but it is also not designed to chase you down and hand you every entitlement automatically. It rewards people who stay informed, who ask questions, and who take a little bit of time now to plan properly. Homeowners over 60 are in a genuinely strong position in this country because home ownership is one of the biggest financial safety nets a retiree can have, but only if you understand how to use that position wisely. Check your assets test position. Explore the Home Equity Access Scheme if your income is tight. Understand your downsizing and superannuation options. Get your power of attorney and Centrelink nominee arrangements sorted, and stay on top of reporting any changes. Do these 5 things and you will be in a far stronger, calmer and more secure position than the vast majority of retirees in Australia today. If you found this video helpful, do me a favour and hit that like button. It genuinely helps this channel reach more people just like you who need this information. Drop a comment below and let me know which of these 5 things you are going to tackle first. Or if you have a question about your own situation, ask it below and I will do my best to cover it in a future video. And if you have not already, subscribe to Australia Pension and Centrelink Update, because we bring you these practical, easy to understand updates on pension rates, Centrelink rules and retirement planning every single week. And trust me, you do not want to miss the next one. Thanks so much for watching. Take care of yourself, take care of your future, and I will see you in the next video.